Imagine driving like a literal bank vault containing $250,000 in electronics down the highway at 70 miles per hour. And the federal government doesn't actually require you to have a single dime of insurance on what's inside.
Which is, yeah, that's completely counterintuitive to how most people think the world works.
Right. But welcome to the invisible, high-stakes world of modern cargo freight. I mean, every time you pass an 18-wheeler on the interstate, it's so easy to just see them as part of the scenery, just metal boxes moving from point A to point B.
Exactly. But what you're actually looking at is a rolling financial liability.
Yes, a massive one. And the system that protects those goods, a financial safety net that keeps our global economy moving, is this incredibly complex high-wire act.
It really is. And, we depend on that invisible net every single day. The food you eat, the clothes you're wearing right now, the laptop you use for work, none of it gets to your local store or your front door without someone taking on this immense financial risk of putting it on the road.
Which is exactly why we're doing this custom deep dive just for you today. We are pulling back the curtain on this hidden ecosystem because, well, it represents a massive hidden cost in the global supply chain.
A huge cost.
Yeah, and ultimately, understanding how this works explains a lot about the prices you pay at the checkout counter. So our guide for this journey is a comprehensive deep dive into modern cargo insurance and risk management strategies.
It's a great source. It really breaks
Yeah.
down how this industry actually operates, especially now that we're navigating the specific realities of 2026.
Okay, let's unpack this. Starting with that crazy fact about the government. I mean, I always assumed these massive trucks were heavily regulated federally, like that there was some mandate forcing them to carry millions in cargo insurance. Is that really not the case?
It's honestly one of the biggest misconceptions out there. If you asked almost anyone, they'd assume the Department of Transportation or some federal agency demands strict cargo insurance for, every commercial truck.
Right, for public safety or something.
Exactly. But the U.S. government, specifically the Federal Motor Carrier Safety Administration, they generally don't care if a general freight trucker has cargo insurance at all.
That is wild.
Yeah. They actually removed the requirement for most property carriers way back in 2011.
Wait, 2011? They just wiped it off the books.
They did. The only real exception they kept at the federal level is for household goods movers.
Oh, like moving companies.
Right. Basically because consumers are particularly vulnerable there. If all your personal belongings get destroyed, that's devastating.
Sure, that makes sense.
And Canada operates on a very similar wavelength. Their federal framework focuses almost entirely on auto liability minimums.
Meaning the truck itself crashing into things.
Exactly. They want to see like $1 to $2 million in coverage for bodily injury and property damage, especially if you're hauling dangerous goods.
Yeah.
But they don't federally mandate cargo coverage either. Though, I should note, industry expectations up there are tied to the gross vehicle weight.
Okay, so the governments are primarily concerned with public safety. They want to make sure that if a truck hits a school bus or, I don't know, plows into a bridge, there's liability coverage to pay for the damage caused by the truck.
Yep, that's the priority.
They couldn't care less about what happens to the flat-screen televisions inside the trailer?
That's the dividing line right there. Liability protects the public from the truck. Cargo insurance protects the freight from the truck. But here is the paradox. Even though the government doesn't legally mandate cargo coverage, carriers absolutely cannot operate without it.
It reminds me of renting an apartment.
Oh, how so?
Well, a city might not have a municipal law requiring you to hold renter's insurance just to live within the city limits, but every single apartment building management company is going to firmly demand to see your policy before they ever hand over the keys.
That is a perfect analogy, yes.
So it's a private market mandate. But if the government doesn't think it's crucial for public safety, why is it such an absolute deal breaker for the private market? Like, why couldn't a carrier just negotiate and say, look, I've got a spotless driving record. I don't need to pass this insurance cost onto you?
If we connect this to the bigger picture, cargo insurance is essentially a mandatory business credential. Without a standard $100,000 policy for general dry freight or, upwards of $250,000 for high-value goods like pharmaceuticals, a carrier is simply locked out of the market.
Because the shippers won't hire them.
Exactly. Shippers and freight brokers functionally require it through their private contracts to secure loads. They want absolute assurance that if their load ends up in a ditch, they're getting made whole. And there's widespread industry confusion about this. People mix up liability, which is damage you cause to others, and cargo, which is damage to the freight you're hauling.
Which makes sense that brokers want to be covered. But why are they so terrified of uninsured freight?
Because of a rather formidable piece of U.S. legislation called the Carmack Amendment.
The Carmack Amendment. Okay, what is that?
It's the bedrock of U.S. cargo liability law, and it enforces strict liability on motor carriers for interstate freight loss. Basically, if a carrier picks up a load in perfect condition and it arrives damaged, the carrier is presumed legally guilty.
Wow. Guilty until proven innocent. That sounds like massive financial exposure.
Oh, it's massive. The burden of proof is entirely on the carrier's shoulders. To get out of paying for the damaged goods out of pocket, the carrier has to prove their innocence using one of 5 highly specific, incredibly difficult legal defenses.
Only 5? What are they?
They have to prove the damage was caused by an act of God, a public enemy, a public authority, a fault of the shipper, or the inherent vice of the goods themselves.
I love that public enemy is still a legal defense. I'm just picturing like a truck getting hijacked by a 19th century cavalry or something.
Right. It's very old school terminology. But practically speaking, because this law creates such intense financial exposure, insurance is really a carrier's only lifeline.
So how do they actually navigate buying that protection? I know from the sources there's a whole maze of coverage options out there.
It is a maze. And it operates like a layered defense mechanism. First, you have primary motor truck cargo policies, which the carriers buy themselves.
Okay, that's layer 1.
Right. But brokers are so paranoid about a carrier's policy having a loophole or, denying a claim that the brokers often buy their own contingent cargo policies.
Just in case.
Exactly. It's backup insurance just to cover the gaps if the carrier's primary insurer refuses to pay.
So everyone is just insuring everyone else because they don't trust the primary policy to actually work.
That's a pretty accurate way to sum it up, yeah.
That leads to the types of policies carriers buy. I understand there's a choice between all risk and named perils coverage.
Yep. When a carrier buys their primary policy, that's the critical fork in the road. All risk is the gold standard. It covers all causes of loss, unless a specific scenario is explicitly excluded in the fine print.
Okay.
The global benchmark for this is measured by what are called the Institute Cargo Clauses, specifically the A clause. It was originally a marine insurance concept that got ported over to trucking, and it offers the broadest safety net.
And the alternative?
Named perils, which is the exact opposite. It only covers the specific events literally listed in the policy.
So if I buy fire and collision coverage, but a tornado flips my truck, I'm just out of luck? That sounds less like risk management and more like a gamble to save a few bucks on premiums.
I completely agree. If tornado isn't explicitly named on the paper, you don't have coverage.
That's insane.
It's an incredibly dangerous gamble, but carriers take it because named perils policies are significantly cheaper. Looking at the 2026 data, a standard dry van all-risk policy runs between $500 and $2,000 annually per truck.
Okay, that doesn't sound too bad.
No, but if you're a high-risk operation, maybe hauling electronics or you're a brand new trucking company, those all-risk premiums can spike over $8,000 a year per truck.
Oh, wow. Yeah, that adds up fast if you have a fleet.
Exactly. So the temptation to save money by switching to named perils is huge. But it creates these dangerous silent coverage gaps that bankrupt carriers every single day.
Speaking of bankruptcies, I noticed a huge warning in the sources about something called the average clause when it comes to how you value the goods. Can you explain how that works?
Oh, the average clause. That's a brutal mechanism if you don't understand it. Basically, you have a valuation alert. Shippers and carriers need to insure the goods for the replacement cost plus the freight, duties, and taxes, not just the manufacturing cost or the selling price.
Okay, give me an example of how that goes wrong.
Let's say you're moving a load of specialized medical equipment worth $200,000 total. But to save on your insurance premium, you only declare and insure it for $100,000.
Because you figure even if there's a minor accident, $100,000 will easily cover a few scratched machines, right?
Right. Logically, you think you're covered for most normal accidents. But the underwriter doesn't see it that way. They see you only insured 50% of the total cargo value.
Okay.
So when you file a claim for $40,000 in actual damage, they invoke the average clause. They say, since you only paid premiums to insure half the load's value, we're only paying half your claim.
Wait, really? So you only get $20,000?
Yep. You get a check for $20,000 and you're eating the other $20,000 out of pocket. It mathematically penalizes you for underinsuring.
That is wild. So a policy is really only as good as the actual payout when disaster strikes. And right now in 2026, the market is hardening fast, inflation is up, threats are up. So even if a carrier does everything right, buys the expensive all-risk coverage, calculates the average clause perfectly, it doesn't mean they're actually going to see a dime.
Not at all. We are currently in a battlefield of claims, primarily driven by a massive theft epidemic. Cargo theft is the single largest driver of claim denials and premium hikes right now.
It's that bad.
It's terrible. The 2025 TT Club and BSI report show that food and beverages are actually the most frequently stolen cargo category globally.
Food and beverages, not like electronics or luxury watches.
Food is the perfect target. It doesn't have serial numbers, it's consumed quickly, and the evidence literally disappears into the black market within days. We're also seeing heavy targeted theft of electronics, pharma, copper wire, but insurers are fighting back.
How so? By raising rates.
Yes, but also by writing strict conditions into the policies called warranties, and these trigger automatic denials.
So they act like tripwires. If you cross one, the claim is instantly voided.
Exactly. Let's look at the top denial triggers. First is mysterious disappearance.
Sounds spooky.
It just means if a driver arrives at a warehouse, opens the doors, and half the load is just missing, but there's no proof of forced entry, like a broken seal or a violently cut padlock, the insurer is likely going to deny the claim.
Because they assume what?
They assume it was internal theft, a loading error, or the driver's negligence rather than a covered break-in.
Wow. Then there's the unattended vehicle theft warranty, which honestly blew my mind when I read about it.
It's one of the strictest out there. Many policies explicitly exclude coverage if a loaded truck is parked overnight in an unsecured lot. If you park on a random street, an unlit dirt lot, or even an open-access truck stop, and the load is stolen, you are not covered.
Here's where it gets really interesting. The theft warranty is basically like having a car insurance policy that only protects your personal vehicle from being stolen if you promise to only ever park it inside a locked underground biometric bank vault.
It really is.
I mean, it borders on physical impossibility. The federal laws dictate exactly how many hours a trucker can drive before they have to pull over and rest. They have to sleep. And secured gated truck parking is incredibly rare in most parts of the country.
What's fascinating here is how these strict exclusions fundamentally shift the burden of proof and really the operational reality onto the driver.
Yeah.
It's no longer about just driving the truck safely from point A to point B.
Right, you're operating a mobile high-security fortress.
Exactly. You have to meticulously plan your route entirely around the availability of secured, fenced-in parking facilities, which, as you said, barely exist.
And the tripwires don't stop at theft. I saw clauses for improper securement, meaning if you take a sharp turn and the load shifts because the straps were bad, claim denied.
Yep.
There's reefer breakdown for refrigerated goods. Standard cargo policies won't cover spoiled meat. You need a specific endorsement, and even then, you need continuous temperature logs to prove a mechanical failure.
And don't forget, inherent vice, which ties right back to those Carmack Amendment offenses we talked about. If you're hauling fresh fruit and it naturally overripens and rots because of a minor delay, or you're hauling raw steel coils and they naturally rust from condensation, the insurer classifies that as a characteristic of the goods themselves. The inherent vice. Claim denied.
The level of perfection required just to get a domestic claim paid is staggering. But as complex as the U.S. market is, the moment that truck drives north and crosses the border into Canada, the rules of the game completely fracture.
Oh, yeah. Cross-border friction is a total nightmare for risk managers. Standard domestic policies often fail completely when operating across the U.S.-Canada border. The primary issue is what's known as jurisdictional whiplash.
Let's map this out. What does jurisdictional whiplash actually look like on the ground?
Okay, say a U.S.-based driver crashes their truck in Ontario, Canada. The physical accident on the highway might trigger Canada's comparative fault rules to deal with the damaged vehicles. But the dispute over the millions of dollars of damaged freight inside the trailer, that might revert back to U.S. Carmack Amendment rules simply because the original shipping contract was drafted in Ohio and specified U.S. law.
So you end up in massive litigation just trying to figure out which country's laws apply.
Exactly. You're fighting over which court has jurisdiction and whose insurance policy has to respond first.
And while the lawyers are fighting over jurisdiction, the carrier is dealing with currency gaps. Like, you might have a perfectly valid U.S. policy with a $100,000 limit, but a Canadian shipper requires a minimum of 100,000 Canadian
Right,
dollars.
because of the exchange rate.
Yeah, if the exchange rate wildly fluctuates while you're in transit, your U.S. policy might suddenly fall short of the contractual minimum the exact moment you have a crash, leaving you personally exposed for the difference.
It's a huge logistical headache. But honestly, the most pressing cross-border threat has nothing to do with crashes or thieves. It's customs. Specifically, the Canada Border Services Agency, or CBSA.
Ah, the customs inspection.
Yes. If the CBSA pulls a truck over at the border, breaks the seal on the trailer to conduct a random inspection, and the goods somehow end up damaged, unpacked improperly, or missing entirely, the carrier is held liable by the shipper.
Wait.
Yep. The carrier then has to somehow prove to their insurance company that the federal customs agents caused the damage, and it wasn't the carrier's own negligence prior to the border.
So a federal border guard breaks my seal to search my truck, the goods get ruined, and I'm on the hook if I don't immediately prove it wasn't my negligence. How's a lone driver supposed to fight a federal agency and an insurance company at the same time?
I know, it feels incredibly adversarial.
Yeah.
But underwriters operate strictly on proof, not assumptions. And this is exactly why the industry has developed the claims packet. It's an absolute necessity now.
What goes into a claims packet?
Drivers must maintain a flawless, airtight paper trail to prove their innocence. They need time-stamped photos of the empty trailer before loading to prove there were no leaks. They need photos of the loaded freight, a clear, zoomed-in photo of the seal number locked on the doors, and photos of the full trailer the exact second the doors are opened at delivery.
But humans make mistakes. A driver is exhausted after 10 hours on the road, it's pouring rain, they forget to snap a photo of the seal, or they simply can't stay awake 24/7 to physically guard the trailer at a truck stop. The burden of proof has become so overwhelming that human capability has essentially maxed out.
Which is exactly why the industry is currently undergoing a radical technological transformation. We are entering the era of digital breadcrumbs. Insurers realize humans can't be perfect, so they're moving away from reactive claims processing, where they just wait for a crash and argue over a check, to proactive prevention.
So what does that look like when a trucking company goes to buy insurance today?
Today, underwriters aren't just looking at the value of the cargo. They are doing a forensic deep dive into the carrier's overall safety profile. They're pulling driver qualification files, checking CSA trends, medical certs, and aggressively tracking hours of service compliance. Your safety culture directly dictates your insurability.
And to actually get competitive rates, carriers are being forced to adopt hardware, right? Telematics.
Absolutely. We're talking mandated inward and outward-facing dash cams that watch the road and the driver's eyes. They have to share their electronic logging device data directly with the insurers.
And it extends to the trailer itself through IoT, the Internet of Things?
Yes. GPS trackers, shock sensors that record exactly how many G-forces a pallet experienced if a forklift dropped it. Door sensors that log the exact second a trailer was opened. This generates the irrefutable digital breadcrumbs needed to win a claim.
So if a load of pharmaceuticals gets rejected at the dock for a temperature drop, you don't argue with the receiver anymore?
Exactly. You just download the timestamp data, proving the reefer unit stayed at exactly -10 degrees Fahrenheit for the entire trip. The data fights the claim for you.
And the technology is changing how the insurance is actually sold, too. I was reading in the sources about embedded insurance. Like digital freight platforms such as Uber Freight now offer one-click cargo insurance via their APIs. A small carrier can buy highly specific coverage instantly at the exact moment they tap the screen to book the load.
It totally closes the protection gap for independent operators.
But the thing that absolutely blew my mind was parametric insurance.
Oh, parametric insurance is a complete paradigm shift.
It's literally a vending machine for claim payouts. There's no human claims adjuster to argue with.
Right.
You put the parameter in, let's say, a major supply chain disruption like a hurricane hitting a specific port, or a hard data point like a 6-hour delay at a border crossing. If the GPS or weather data triggers that specific parameter, the machine automatically drops the payout into your bank account. It completely removes the human friction.
It does. But, this raises an important question regarding privacy and autonomy in the trucking industry. How much surveillance is required to be considered insurable today? Insurers aren't just passively covering freight anymore. By mandating eye-tracking dash cams, continuous GPS, and real-time temp logging, they are actively managing driver behavior and the physical transit environment.
Okay, let's unpack all of this. So what does this all mean? If you're a carrier, a shipper, or just someone trying to understand the logistics world in 2026, There is a clear strategic playbook you need to follow from these sources. First, you have to audit your policy right now for those theft warranty clauses. You need to know exactly what your parking requirements are.
Because if you park at an unlit rest stop and your policy demands a gated facility, you are entirely uninsured.
Right. Second, match your coverage limits to the actual value of your specific load. Don't carry a $100,000 policy if you regularly haul $150,000 in goods. The average clause will destroy you, and you'll just be self-insuring the gap.
Third, you must master the paper trail. Train your teams on the claims packet. If you don't have those timestamp photos of the empty trailer, the loaded freight, the seal, and the delivery, you are operating with severe vulnerability.
Fourth, if you cross the U.S.-Canada border, explicitly verify your cross-border endorsements. Ensure you have territory limits that clearly map out which country's laws apply.
And finally, embrace the tech. Dashcams, IoT sensors, and real-time GPS aren't luxury add-ons anymore. They are mandatory loss control tools if you want your insurance premiums to be remotely affordable.
Which leads us to a final thought for you to ponder long after we wrap up here. We started by talking about the messy, complex reality of liability, the human struggle to prove who is at fault when goods are damaged. But as IoT sensors, telematics, and parametric insurance converge to track every single variable, every temperature drop, every hard brake, every door swing in real time, does the concept of insurance actually disappear?
That's a fascinating thought.
Right. In the near future, maybe insurance companies stop being financial safety nets that pay out after an accident and instead become omniscient supply chain managers that physically prevent the accidents from ever happening in the first place.
It's a profound shift from risk mitigation to risk elimination. That vault on wheels is really becoming a highly surveilled, deeply interconnected smart vault.
It really is. Well, thank you so much for joining us on this deep dive. We hope this uncovered the hidden systems that keep your goods moving and your shelves stocked. Keep exploring, keep questioning, and keep looking at the hidden layers of the world around you.